Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got a fantastic show for you this morning. And as always, make sure you send your questions to Brian Rezny at ReznyWealth.com, and do visit our website, ReznyWealth.com. Rezny Wealth Management is a fee-only fiduciary money management firm. Let me explain what that is. Fee-only means the way that we work is we are only compensated by our clients. We have no side deals, no commission, no conflicts of how we're paid. Unlike a brokerage firm, a Wall Street firm, a bank, an insurance company, we don't get involved in any of those practices. We're a fee-only fiduciary money manager. Fiduciary means we legally work for our clients 100% of the time in their best interest. Again, Wall Street firms, banks, brokerage houses, insurance companies are not fee-only fiduciary money managers. As a money manager, we actually manage your money. We don't have a fancy title like advisor. An advisor at a Wall Street firm or bank is really just a glorified salesperson. We're an actual money manager. So our clients hire us to manage their wealth, do the financial planning items that need to be done, and make sure we keep them on track with their overall portfolio and their financial health. So that's Rezny Wealth Management. But to learn more about our firm, go to ReznyWealth.com. Check out our website. You can also check out our consultation tab if you'd like to talk to us about managing your wealth professionally. You know, I've got a lot of questions already coming in, but some of the topics I want to talk about before I go to my first question, let's talk about recession and market collapse. You're hearing a lot of lingo out there from, the big media firms about recession, market collapse, what's going to happen. Reality is this: we have volatility. It's normal every single year, whether it's in the stock market or the bond market. What's interesting is if you look at the equity market, let's say it's down 10 or 12% year to date. The bond market, if you look at long-term treasuries, they're down like 16 to 18%. But people say, wait, I thought bonds are safe. Bonds can be as risky or more risky, depending on the cycle we're in, than realistically the equity market can be from time to time. So just realize that. Are we headed for recession? That's really hard to tell, but some of the signals are showing we're definitely in a slowdown. The Fed will be raising rates. My gut reaction is they might raise rates 2 different times, 50 basis points each. That's already kind of baked into the cake, but the economy's already slowing down. Do I expect a big market collapse? No. Do I expect a 10 to 20, maybe as much as a 30% pullback? Potentially. But if you're diversified properly and you have some little bit of cash on hand, you could redeploy that in the right places as you could buy high quality assets at a little bit lower price. Let's also talk about your so-called advisor sold you an insurance policy claiming it will give you tax-free income. Another scam and what you need to do. If for some reason this year we've been inundated actually by people calling my TV radio shows and our office who were sold an insurance policy by their so-called advisor claiming they can get tax-free income. Some of these people were even talked into cashing out an IRA, and they were told they wouldn't have to pay income tax on an IRA if they bought an insurance policy. These are all blatant lies. If your advisor is trying to sell you an insurance policy for your IRA or claiming there's tax-free income, they are blatantly lying to you. By the way, putting an IRA into an insurance policy is a prohibited transaction by the IRS. You can't do it, but some of these so-called advisors will basically trick you into selling your IRA, paying huge taxes on that, then taking that money, putting that into a worthless insurance policy that's not going to give you free income for life. It's going to cost you a fortune, and it's ultimately going to ruin your retirement. So if somebody's pitching you that, or maybe you've already fallen prey to that, you better get some major help from a real firm real quick, because your retirement could be in jeopardy. Let's talk about the inverted yield curve. You're hearing talk about that today also. What does the inverted yield curve mean, and what does that mean to the overall economy and the markets? All the inverted yield curve means is we like to look at the 10-year Treasury and the 2-year Treasury. And what happens is if the 10-year Treasury actually has a lower interest rate than the 2-year, meaning they invert. So 2 years interest is higher than a 10-year. That's called an inverted yield curve. It doesn't signal a recession. In fact, we've had many inverted yield curves over the decades, but we could have a recession, and often when we have a recession, we're in an inverted yield curve. So again, it's not a telltale sign for sure that we're going to have a recession, but I will tell you as a money manager, we are definitely seeing a little bit of a slowdown. We're seeing a little bit of a pause, which ultimately is healthy for what we feel a couple steps back, so we can go 5 or 6 steps forward. Remember, nothing goes straight up. Nothing goes straight down. If you're properly managed and you have your portfolio properly researched and looked at on an ongoing basis, there's always opportunities to upgrade your portfolio when the time is right. Unfortunately, too many people panic. They might raise cash, sit on the sidelines, and then things recoup and you lost all that opportunity. That's where real money management comes into play. And ultimately, emotions are going to be bad for your financial health. Let's talk about that variable annuity that so-called advisor sold you. Did you know the average variable annuity that we review when somebody comes into our office that was already sold one of these garbage products rob your retirement as much as 4.5% every single year? You heard that right. So imagine this. You have $1 million in a variable annuity. And let's say that variable annuity made 10%. After the crazy expensive fees on that variable annuity that so-called advisor sold you, take off 4.5%. You made 5.5% on that variable annuity, but you took the same risk as the investment markets did. But you made almost half the return. The average variable annuity that we review at our office has an annual expense ratio every single year of 4.5%. Imagine if you have $1 million and it's costing you $45,000 of your retirement income because you were sold a piece of junk by a so-called advisor who wanted to line their pockets in commissions more than yours. Variable annuities and annuities in general are the death sentence, in our opinion, to your retirement and your financial health. Let's talk about the emotional investment decisions and the hyped up news media. That is also going to be your big enemy going forward. General media, think about this, folks. When you watch a lot of the media outlets and they talk about the markets and what's going on with the economy, do they ever talk about all the misdoings that Wall Street firm did, or that bank was fined $3 billion last year for all the mortgage stuff they did to their unsuspecting clients, or how they were selling you investments that weren't suitable, and how they were fined billions and billions of dollars year over year? The mainstream media never talk about that. And why is that? Because that's their bread and butter advertisers who pay big money to advertise on those big stations. You need to make sure you check out the firm you entrust your money. What happens, though, is people watch the news. The news hypes a lot of things up that's already passed, and they keep talking about it. Unfortunately, some investors start to get emotional, and they start to make decisions off that hyped up news that is only there to basically generate revenues for the news media company itself. Remember, the news media are going to basically hype the news. It's going to cause you to make investment decisions that are probably more emotional than well thought out, and that's ultimately going to hurt your retirement and your financial security. As I've talked many times before, research proper money management is going to help you secure your retirement and move ahead in a thoughtful pattern. If the advice you're currently getting is not working, if you're realizing the advice you're getting is more sales than real money management, and the firm you utilize is not a fee-only fiduciary money management like Rezny Wealth Management, give my firm a call. We do manage larger portfolios. Our minimum client size is $1 million on up. So if you'd like to talk to us about managing your wealth and find out about our services, call our number at the bottom of the screen or visit ReznyWealth.com. I'm going to take a quick commercial break. I'll be right back with your questions. Send those to Brian Rezny at ReznyWealth.com. And do make sure that you visit our website, ReznyWealth.com. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make, being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report, Why Annuities Are Dangerous to Your Wealth and Retirement. And we're back, and I hope you're enjoying today's program. Again, send those questions to Brian Rezny at ReznyWealth.com. You know, our first question of the day is from Brad from Florida. 90 years old, in good health. I have $1.7 million to invest conservatively for income. My investment manager has recommended structured notes. I've looked them up. They're complex derivatives, and I'm questioning suitability for me. Brad, I am glad you actually looked that up. First off, your investment manager is really a salesperson. Wall Street firms manufacture what's called structured notes. So these are the big Wall Street firms and small Wall Street firms. They manufacture what's called a structured note. I do not like structured notes, and you should not either. And you should not invest in a structured note. They're complicated, they're expense-ridden, they have mediocre returns most often, and again, there's always downside to every single investment. There's no reason to insanely lock your money up in a structured note with high cost structure and added risk when you don't have to. It's certainly not an investment for quality income. Your advisor really is acting as a salesperson, selling the products he or she is required to sell that his or her firm has manufactured and is making them sell to you. But fortunately, Brad, it sounds like you've actually done some of your homework and you realize maybe it isn't right for you. I'm glad you did that. I wish more investors would take the time not only to do a little bit of base research, but certainly check out the firm you entrust your money. So many of you out there are taking advantages every single day because you don't go to the SEC site or the FINRA site to check out the firm you entrust your money. Do you know the vast majority of big Wall Street firms, banks, and insurance companies have been fined billions of dollars every single year for misdoings against you, the client? But people never check them out. So then you hire firms that you think are of quality, but they're not. And remember this, there is not one bank, one Wall Street firm, one insurance company that is a fee-only fiduciary money manager. Not one of them. Carmen, you mentioned a report on your website for checking out advisors and their firms for past misdoings to their clients. Also, I was recommended investing in an annuity. What is your advice on this? Carmen, first part of your question, go to ReznyWealth.com, scroll to the bottom of our homepage, and you will see Real Advisor, Fake Advisor report. You can download it for free. At the end of that report, we'll list the SEC site and the FINRA site to check out the firm you entrust your money. One of the craziest things that I've seen is, in fact, it goes on right here in Fort Myers, Cape Coral, and Naples, which we have offices in. We had a recent client come in where their so-called advisor not only had them cash out their IRA to sell them an insurance policy, sold them a Ponzi scheme investment. Yeah, a Ponzi scheme investment, then tried to cover that up by basically doing a promissory note back to that client saying, hey, we'll pay you back if you essentially don't report us to the regulators. So again, that's a prohibited transaction. When this person came in to talk to us, I explained that you need to report this person to the SEC and FINRA because this person's probably done this to other unsuspecting investors just like you. The bottom line is check out the firm, check out the person. If you want that information, go to ReznyWealth.com. As for the annuity, there are not good annuities. Annuities are sold by salespeople under suitability. They're sold because of lavish commissions, kind of like insurance policies are, to the selling agent. So your advisor is not an advisor, again, a salesperson selling a high commission annuity product. When you buy an annuity, you have insane lockups to get all of your money out. Taxes are higher when you take it out of the annuity. Expenses are high on an annuity. There's no reason to ever invest in an annuity unless you're trying to make that so-called advisor rich instead of your overall financial net worth. and your portfolio. So don't do the annuity. Look for real advice. You can always visit ReznyWealth.com. Click on our consultation tab if you qualify for our services. We'd love to have you come in and talk about how we can professionally manage your money to get you back on track. Ron in Estero, Florida. Brian, what do you think of the subject of preferred stocks in a portfolio? Ron, great question. So preferred stocks are kind of like a hybrid of common stock. They pay a higher dividend rate. Preferred stocks are appropriate at certain times of the interest rate and the economic cycle. Right now is not the time, in our opinion, to own preferred stocks. When rates finally tick up, and they basically are at the point of really not going up anymore, they've kind of topped out, and we're starting to see that rollover of interest rates again, that would be an excellent time to look at preferred stocks. Preferred stocks act like long-term bonds, so they're going to have volatility, and in fact, if you look at preferred stocks year to date, they've done really poorly, in fact, worse than the overall equity market in general. And the reason? Because they're kind of like a stock and a long-dated bond rolled into one, and as you probably have noticed, interest rates have moved up, bond values go down. Remember, it's like a teeter-totter. So now is not the time to do preferred stocks. I think you have to look for other areas in general. George, what is your thoughts and opinions on ESG scores? Let me explain what that means, folks. ESG means environmental social governance. So every company out there, big companies, small companies, they look at what's called an ESG score. I don't think you should look at an ESG score when you invest. Let me explain why. ESG is, so if you were an ESG company, ExxonMobil would obviously score really bad because environmental, they produce oil and gas. That's their business. So if you only bought companies that had really good ESG scores, you would never buy ExxonMobil or any oil company in general. But if you look at last year and this year, the two best performing sectors, or the single best performing sector for the last 2 years, is oil and gas. So what I try to explain to investors is don't exclude an asset. If an asset is of quality, it's profitable, it's growing, and there's opportunity to make money, you want to make sure you take a look at it. You may not add it to your portfolio, but taking something away like oil and gas or maybe a different industry just because of an ESG score could have a detrimental impact on your portfolio. So we don't believe in ESG scores. I would not utilize those in your overall portfolio. And I think if you do, you're ultimately going to have a big issue in general with your overall portfolio. Peter from Fort Myers. What do you think about the overall market being taken down like 1926 style? Realistically, Peter, you're going to have volatility in the investment market. If you go back in history and you look at 1926 and really the Great Depression, most people really don't understand what caused that. What happened was the actual government took away liquidity back in the 20s. And that's what made the overall equity market and the economy really collapse. They took money out of the system. So what the Fed has learned and the government has learned from past mistakes, let's say in the 20s, is we don't want to take money away. We actually want to add liquidity so that the economy can recoup and come back. And that's what you've seen really in the last 50 years. So the Fed and the government becomes accommodating, which actually helps spur and regrow the economy. So I don't see a 1926 or a Great Depression scenario happening anytime soon. The Fed is in a whole different holding pattern, a different style. They do different things today, and they've learned from prior mistakes. Is it perfect? Absolutely not. But what I'm going to suggest is this. Expect a 10 to 12% correction every single year in all asset categories. It's very normal. Once every 3 years, we get about a 20% correction. And once every 5 to 10 years, we usually have a recession that folds in, and you could have a correction that pulls back in the 30 percentile range easily. Are they short-lived? Most of those are 12 to 15 months or less. So just realize short-term volatility creates great opportunity not only for your portfolio, but your long-term wealth building opportunity. If the money's managed properly, you don't get emotional, and you upgrade the portfolio when necessary. I'm going to take a quick break. Go to ReznyWealth.com, click on our consultation tab, download any of our groundbreaking reports on our website, scroll to the bottom of our homepage, some great reports to download that will educate you thoroughly. And make sure you send your questions to Brian Rezny at ReznyWealth.com. And if you're unsure about your portfolio, the advice you're getting, and you're looking for real money management, and you'd like to talk to my firm about managing your wealth, you're more than welcome to call the number on the bottom of the screen during the week. Or again, visit our website, ReznyWealth.com, and click on that consultation tab. I'll be right back after this short break. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not family fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 Investment Risks You Must Avoid Now. And we're back, and I hope you're enjoying today's program. Send those questions to Brian Rezny at ReznyWealth.com. And make sure you do visit our website, ReznyWealth.com. You can sign up for instant email alerts that come out throughout the week and throughout the month. Great topics you need to understand and learn. If you're trying to protect your money, from the annuity charlatans out there, the Wall Street people, if you don't want to be sold investments, but you want your money really managed, as I always suggest, the only kind of firm you should hire is a fee-only fiduciary money management firm. Firms that legally work for you, only get paid by you, avoid the conflicts of commissions, creating products, sales agreements. Stay away from those kinds of firms because ultimately it's going to hurt your return and your financial security. Cliff, most scary of all is our total incompetence of our government, both here and abroad. Any optimistic words for us? Cliff, great comment. Think about this, and it's sad that in America alone, with this great country, that we have the kind of politicians and the kind of bad governance that we do. My personal opinion, 90% of politicians don't do anything or do very little to really help the American people. 10% really want to help and do a good job, but you're held back by the other 90%. I think in other parts of the world, it's even worse than that. But in America, for some reason, we are built different. And the American people have drive, and we always seem to persevere and push ahead. And I don't think it's going to be any different this time. So what I would say is this. There's been an incompetence in the government today, 20 years from now, 100 years ago. It's always going to be there. It's always going to come back. But America's America. Have patience and invest properly, and I think ultimately you'll have a great opportunity for your portfolio and the overall returns of your portfolio. Mark in Naples, Florida. What do you think about moving my IRA into an insurance policy for retirement income? My advisor is suggesting this. Mark, I'm not sure if you heard the first part of this show, but one of the things you don't want to do is you don't want to cash out an IRA and put that into an insurance policy. Number one, you can't take an IRA itself and put it into an insurance policy. It's a prohibited transaction by the IRS. So what your advisor, which is not an advisor, your advisor is acting as a charlatan, as a salesperson trying to line their pockets greatly. Insurance policies pay ginormous commissions. Your advisor, salesperson, so-called advisor, is trying to make the mortgage payment or car payment, so he's trying to convince you to cash out your IRA so you pay 40% tax, take what's left, buy an expensive insurance policy that's going to ruin your portfolio, your retirement, and your financial security. Your advisor should be put in jail for bad advice and really incompetence and almost stealing your wealth. I have had so many calls this year alone from people that were duped just like you by their so-called advisor to take an IRA or to buy an insurance policy for retirement. It's a blatant lie. You're not going to get tax-free income from an insurance policy. You can't put your IRA in there. You're going to pay tax to do it. Do not do it. Kyle in Estero, Florida. Do you have any tips for someone looking to retire at age 50? Yes. Number one is you want to make sure you put together a real retirement plan. So whether you're 40, you're 80, or you're anywhere in between, every person should have what's called a retirement plan. It's basically like a Google map, we call it, from here's your age, Here's when you want to retire. Here's how much you need to save, the rates of return, and all those things that are built in with inflation. Remember, Kyle, when you're 50 years old and you retire at 50, you could live well into your 90s. So you're talking a 40 to 45 year retirement. You have to factor inflation in. At our firm, with our clients, we actually do that as part of the money management process for our clients. We do the retirement plan because we want to make sure that our clients have a good grounding and footing and foundation so they can see exactly, here's where I'm at. Here's what it's going to take for me to be successful throughout retirement, so we can show them the different ideas, retirement plans that are going to make most sense. Most investors never do any kind of retirement plan. They just kind of pick a number, they jump into retirement, they're 10 years into it, they realize they didn't plan properly, they have to go back to work as a Walmart greeter, and you certainly do not want to do that. Kim in Naples, Florida. I'm starting to realize our financial advisor is really a salesman. How can I find a real advisor who works for us and manages our investments? Kim, I'm glad you figured that out. Hopefully you figured that out at a young enough age. Reality is this, in our opinion, 90% of advisors are really acting as salespeople, working for Wall Street firms, banks, brokerage firms, or independent firms. They're selling product, they're not managing any money, they're not really advising at all, and they're really worried about their bottom line and not yours. We estimate about 10% of firms nationally are fee-only fiduciary money management firms like a Rezny Wealth Management, who actually manage your money, legally work in your best interest, and only are paid by you, the client, with no side deals, again, like the banks, brokerage houses, and insurance companies. You want to avoid that. So what I would suggest you do, go to ReznyWealth.com. You can scroll to the bottom of our homepage, and you'll see a special report, Fake Advisor, Real Advisor. Download the report. It's free. At the end of that report, you'll see the FINRA and SEC site to check out the firm you're looking at. So if you want to interview Rezny Wealth Management, you can download that report. It'll tell you how to check out our firm. Any firm you interview with, you take that report with you. It's got a nice questionnaire. It'll tell you the questions to ask to find out if, in fact, that firm is a real firm, if they're a fee-only fiduciary firm. Unfortunately, what you're going to find is a lot of these firms, the majority, are not fee-only fiduciary money management firms. They're going to give you a lot of hocus-pocus language. You need to get it in writing. That's the best way to handle it overall. Folks, I'm just about out of time. As I've always talked with our show, if you have questions about your portfolio, send them to Brian Rezny at ReznyWealth.com so that you could have those answered at our next show. Make sure you visit our website, ReznyWealth.com, for times availability of all of our radio and our TV shows. And if you're a larger investor and you have $1 million or greater and you're looking for real money management and you'd like to talk to us about managing your money, again, call the number on the bottom of the screen or go to ReznyWealth.com, click on that consultation tab. Don't settle for bad advice. Don't settle for bad client communication. Don't have doubts about your advisor's ability. You should have a firm that cares about you, cares about your wealth, and actually manages your money without all those conflicts. You should be number one. That's how we treat our clients. So if you want a difference in firms, call Rezny Wealth Management during the week. You'll be glad you did. The biggest comment we get, we should have come in sooner. Maybe we'd be a lot further ahead than we are. Have a safe and profitable day.